I mean, we've had some volatility on the markets over the past week, and we had the JSE yesterday down, then up, closing slightly higher, although we did have global markets trending lower yesterday, and it seems that risk appetite is starting to wane at this point.
Maybe I don't agree entirely with you there. I think looking at the S&P in particular, that's up 48% off its lows in March. So just reflecting that there has been a definite change in trend, and the markets can't go up day in, day out. At some stage they do need to retrace. But what we are seeing is that for every time the markets go up 500 points, they only seem to retrace 100 points, and then the bull market rally continues.
Okay, so the upward trend really is still intact at this stage then, Simon?
Yes, absolutely. And I think last night, just before the close of the US market, we saw Goldman Sachs coming out with quite a bullish second half GDP forecast for the States, and they're predicting that will grow at 3%, which is significantly higher than most other economists have forecast. Just showing again, once again, that there is a change in sentiment. And I think the big thing with the markets is that relative to other asset classes, equities stand head and shoulders above the rest. We've spent considerable time over the last 2 weeks re-looking at our asset allocation models, and just looking at those returns. If one starts on the bottom end of the scale and looking at the after-tax real returns that investors will receive, an investor investing in cash now is likely to receive a negative return of about 3% going forward. Bonds is not much better at 2%, and that's after inflation, after tax. Then we calculate that preference shares will generate a return of about 2% for shareholders going forward. Property in the region of about 3%, and equities, in spite of the significant run that they've had, we still believe that in real returns after tax they'll still generate a return of 4.5%. So despite the strong markets, equities still seem to be the asset class to be, and I think a lot of people were left short of the market in terms of their equity exposure, and there's a little bit of a race now on at the moment to increase their equity exposure. That's why we're seeing, as soon as there's even a marginal retracement in the market, that buyers quickly step in, and there does seem to be some sort of strong positive momentum in the market at the moment.
Just seeing the gains that we have seen on the equity market since early March, and we're talking about 38–40% from the lows, and also the results that we've seen coming out of companies. Do you think that the market is looking fully priced at the moment, or do you think there could be still some way to go?
I think the results that are coming out now are, they're a lagging indicator, and what was happening in the market in November, October last year was indicative of the results that we're seeing now. So the positive sentiment that you're seeing in the market at the moment is probably a reflection of what most people feel is going to happen in a year's time in the market. Just reflecting that the panic's out of the market, we've seen the worst, and that next year will be a lot better. Interestingly, if one looks at TED spreads, which were widely followed when we were in the nadir of the crisis, and those have lessened to the smallest number in the last 2.5 years, just indicating that the panic is completely out of the system. And looking at equities, we've also recently rerun our IRR models on about 200 companies across our stock universe, and what those are indicating to us is that there are certainly pockets of value in the market, but certain sectors are more fully priced than others. Looking at those results, in terms of the top 40, we think that in terms of its IRR, that's got an IRR at the moment of about 8%. The Findies at about 12%, mid caps at about 14–15%, and then the smaller caps at about 18%. So it would appear that there's a bias for value in the mid to small cap sectors.